Welcome, everybody. It's Josh Lewis with Bywise Mortgage here with the Mortgage and Real Estate Update. We're going to go through a couple of things, just a couple of interesting updates. I actually wanted to have some nice slides with some additional details, but with rates this low and kind of what we're going to talk about, some important news coming out tomorrow that could move the market. Just busy here, still trying to go through stuff. So you're going to see I want to jump in. Actually, I don't even really know where I want to start, but let's jump in here. Let's first of all make me smaller and the data bigger. And let's just start here. I don't generally like to start with interest rates. Interest rates are the least important part of everything we do. If someone's looking at buying, looking at refinancing, obviously rate is important, but the bigger stuff in the context of what's going on, direction of the market, guidelines, that stuff. But let's start with this because right now, today, the interesting information is mortgages. So if you remember on Monday, we were talking about this pennant formation between the 50-day moving average rising, 25-day moving average going lower, and we've been sitting there between it for, what are we looking, 3-4 weeks? And we were expecting a breakout to the upside. Well, today we kind of broke out below it. And what do we attribute that to? Your guess is as good as mine, but if you look back here on Wednesday, yesterday, this one that pushed us just below, we had a really strong ADP, strong is the wrong word, we had a really unexpectedly positive or a less negative report for the Adp Jobs Data. So Adp, obviously, as you know, they may do your payroll, the biggest payroll vendor in the United States. They aggregate that data and they sort of every Wednesday publish their information. I should say every Wednesday. The Wednesday before the monthly employment report comes out, that the Department of Labor does, they release their own number, and it's based off of what they see with the companies that use them for payroll in terms of hiring and firing and what that looks like. So it was very negative information. It was just a ton better than what was expected yesterday. So as we've seen for the last month, the stock market says, hey, look, things aren't as bad as we thought. So stock prices up. And that's really the only thing we can attribute this to. We have the monthly employment report coming out tomorrow morning, based off of the ADP report being better than expected. People are now expecting a positive surprise with that report tomorrow. And with that being the case, we've kind of been pushed down to a lower level here in bond prices, which is bad for interest rates. Now, in the grand scheme of things, how much worse are we than the other day? About 25 basis points, like a quarter point. So you have a $300,000 loan, 25 basis points, a quarter point is about $750 worse in pricing to get the equivalent interest rate. So if 3 1/4 was 0 points on Tuesday, today it's about a quarter of a point or $750 on that $300,000 loan. Now, a couple of things that I just want to follow up on what we had talked about last week. The Freddie Mac Primary Mortgage Market Survey. This is the average of the last week's insured loans by Freddie Mac. And what they report here is last week we were at 3.18. That was a tiny bit up. The previous week was 3.15. But for all intents and purposes, we went nowhere because a week ago they were reporting fees and points of 0.8 at 3.15. Now we're at 3.18 with 0.7. For all intents and purposes, those are identical. They are the same. And the thing that I was talking about last week is if we look the national mortgage rate snapshot 1 year ago, we were at 3.82 and 0.5. And actually, here's the 1 week ago. Their little chart is a little bit off, but 3.15 and 0.8. Today, 3.18 and 0.7. Functionally the same. But what we want to look at is a year ago, we were at 3.82 at 0.5%. Or 0.5 points. And that was actually high. The number that we usually see is 0.3, 0.4 points is what most people are including in terms of buying down an interest rate. So largely what we're seeing the last few weeks with the national average as measured by the primary mortgage market survey coming down is simply people paying more points to get their loan. And as we mentioned, there's a couple of large national lenders that are pushing that on borrowers saying, hey, rates are at all-time lows, and why not pay a point or 2 points and get it down to the absolute lowest level? And that may or may not be the best decision for any individual borrower. The only way to know is to pencil it out, put it on paper and show you what it looks like over time, how long it takes to recoup the additional points that you're paying in terms of the monthly savings. Usually people are surprised. It's a fairly small monthly savings for a fairly large chunk of your equity that you're trading and paying points. So the other thing I wanted to point out is, let's go back here. If you can see, we've just been slowly inching down in bond prices, which means rates should be going up. But we have watched over the last few weeks that rates are going down. Why is that? Well, if you watched about a month or so ago, I first showed you guys this chart, and this is a large reason of why we think interest rates will be going lower. So when you look here, our historical spread, this is over the last 10 years, but the historical spread, the high was 2.2 and the low was 1.4. And this is the spread between the 30-year fixed mortgage as measured by the primary mortgage market survey by Freddie Mac and the 10-year Treasury. This average over the last 10 years has been 1.7%. And right now, we are down to the lowest level in quite some time, 2.49, about a 2.5% spread. We had peaked up here at 2.71. So it's improved almost 0.25%, while mortgage bonds, the underlying investment, have actually gotten a little bit worse. So it's telling you that lenders are getting more comfortable with lending and rates are kind of normalizing. So I would expect, I don't know how long it's going to take to get back down under 2%, but my guess is we're going to get to 2% in the next 6, 8, 10, 12 months. And why is that important? Let's roll back over here. You guys probably think I'm nuts going through all of these charts, but so why am I in the wrong one? Let's go. Okay, here we go. So this is the 10-year Treasury. So the 10-year Treasury, as you can see, also flat, 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 flat. But the yield is going up. So what we're saying is, if we normalize down to, say, 2%, which is higher than the last 10 years average, this can go up. So we're at 0.82. So the high range was about 0.75, going back all the way to early March. This could go up to 1 or 1.3 if we were to normalize down to that 2% range, and rates are still going to stay where they're at. If rates, the 10-year Treasury stays in this range of 0.75, goes even lower, some really smart experts are calling and expecting them to decrease down to the 0.3% range. And if we were to normalize down to 1.7, same as we've seen over the last 10 years, we could see rates go to as low as 2%. So for the most part, mortgage rates, what we're seeing, they're identical to where we were on Monday. Maybe you're an eighth or a quarter point worse than where we were at that time. But the important news is what happens tomorrow. Do we get a strong employment report? And it's going to be bad. There's going to be a lot of jobs lost. But is it going to be like the ADP, where they were expecting 8 million jobs lost and it came out at like 2 million? Are we going to see something so much better and the markets take that as a positive and stocks are sort of off to the races? Right now, what we're looking at, almost every predictor of the future direction of the stock market is flashing giant warning signs saying overbought. Stocks have recovered way too quickly from what is a major shock to the economy. So earnings, like you've all probably heard of the price to earnings ratio. Well, when earnings go down, when companies get shut down, they can't produce their goods. There's no one buying them. People can't fly. People can't stay at hotels. People aren't eating out at restaurants. Any number of industries are way, way down. Earnings are down, but prices are up. That can't continue on indefinitely. Either earnings are going to correct massively and we're going to see a giant spike in earnings, or prices of stocks are going to come down. If the prices of stocks come down, that should be supportive to bonds, both treasuries and mortgage-backed securities. That's why we're expecting rates to go lower. But that being said, in the short run, the longer-term trend can still be for lower interest rates, but the short-term trend can be contrary to that and could pop up. So if stocks continue to do well and continue to defy gravity for another week or month or quarter, we could see treasuries get worse and mortgage rates get a little bit worse. But we could also see lenders trying to keep their volume up, normalizing back to that spread that we've seen. So the other two things that I wanted to touch on tonight that I think is important to most everyone, let's pop this back up here and you can see my ugly face a little better. Self-employed borrowers, we're kind of in this gray area. So as a lender, when we're trying to determine what is the monthly spendable income that a self-employed borrower generates, generally what we're doing is looking back at the last year or two of tax returns and averaging that income. Well, what almost everyone knows is 60, 70, 80% of businesses have been negatively impacted by the shutdowns with coronavirus. It might have been a little bit, it might have been a lot. So lenders were sort of left to their own devices largely to figure out how do we calculate income for these people. Well, now Fannie and Freddie issued guidance saying that we're going to look at 2 months of bank statements. So almost all lenders are requiring us to get a statement from the borrower stating how impacted their business was by the virus. I have business owners that actually their income went up. For the majority, most went down, some of them entirely. Best example I have a hair salon owner that's wanting to buy a house. She was shut down for 2.5 months here in Southern California, and probably the hairstylists in most parts of the country are in the same situation. So we need a letter stating how they were impacted. We need a year-to-date profit and loss showing what that income looks like on a year-to-date basis. And we need 2 months bank statements supporting what we're stating that income looks like. So for the most part, it's harder for self-employed borrowers to qualify right now because we don't have a pay stub issued by a third party, an employer, showing us what they're making and confirming with a written verification of employment what income looks like. So it's really important. Obviously, we're in California. We help borrowers throughout California. If you're outside of California, make sure you're talking to an expert because it's super easy to look at documentation the way we've always looked at it and tell someone, hey, you're great, you qualify, when in reality, under the current situation and for the foreseeable future, we're going to be looking at some different data and having to look a little more closely at self-employed borrowers. Another piece of news that happened while I was out that I haven't had a chance to touch base on, just wanted to point out that both Fannie and Freddie have come out and stated that if you're in forbearance, it used to be you had 12 months waiting period before you were eligible for financing, either to purchase or to refinance. And both of them have stated that they will allow borrowers, once they are done with their forbearance, so either it's brought current and put behind them, or they've entered a repayment plan and they're 3 months into that repayment plan successfully, we can go back and do a loan either to refinance or purchase a new home. So both of those pieces of information are good news. There's so much misinformation in the early parts of the coronavirus of what's going to happen, people panicking. And I feel like we're getting clarity slowly but surely. More questions have come up. More people have had time to sit down, think it through, and come up with solid decisions on the part of Fannie, Freddie, FHA, VA of how we're going to come through these things. And for the most part, it's pretty logical. There's nothing working against borrowers or making it unnecessarily difficult to qualify other than just the employment and income environment that we're in right now. So always want to point out the resource that we have available. My business partner, Scott Shang, has created the forbearance report, forbearancereport.org, forbearancereport.com will also get you there. Any information that you're looking for. We continue to see misinformation, not just in the news media or blogs or other people making comments on social media, but big major national servicers giving people incorrect information about what they are able to do in terms of forbearance, getting out of forbearance, qualifying after forbearance. So continue to use that as a resource. If we can help you, reach out. Again, had a couple of borrowers this week, one in Idaho and one in New York City, found us through one of these videos on YouTube. We're not able to help them directly, but we have a great network. I have someone that we connected both of them, one in New York City, one in Idaho Falls, and we're able to get them connected. So feel free to reach out. If you don't have a local trusted expert resource, we have them. Would love to connect you with someone so that you're getting the right answers. And if you're in California, obviously, as always, we would love to help you. If you're finding this on YouTube, which we're streaming live there also, make sure you subscribe. Scott and I are going to be really increasing the volume of content that we're putting up there. Like the video, subscribe. Same thing with the YouTube channel. Make sure you like us, follow us on Facebook, because we're going to be ramping up the content that we're doing, getting a lot of good feedback, both in terms of, hey, this is good content, but also asking, hey, can you talk about this? Can you talk about that? So we're going to be taking some of that feedback and really getting some tailored information out on different topics that you guys are interested in. So let me know how we can help. Thank you for checking in. It'll be interesting. We'll be back Monday night, and I'm super interested to see what happens with tomorrow's employment report. All right. Have a great night. We'll talk to you soon.